Let's talk a little bit today about a few key factors that mortgage lenders consider when reviewing an applicant's credit. The information I'm about to go over today are general guidelines from each of the different loan programs, such as VA, conventional FHA, and USDA. There are three key factors I want to go over with you today. Key factor number one, late payments within the past 12 and 24 months can be a hard stop on a loan application. We as lenders may not be able to move forward until the late payments age out, meaning you must have at least 12 to 24 months of on-time payments since the most recent late payment. Make the commitment now to pay each of your debt obligations on time. Let this be a priority for you beginning now if you've been having a problem with that. Key factor number two, foreclosures, short sales, and bankruptcies also need time to age out. Generally, there must be 2 years since the recording of the foreclosure and short sales, and 2 years since the discharge of a Chapter 7 bankruptcy. Chapter 13 bankruptcy is a little bit different, and since that is a repayment back to all of your creditors, that you can apply for a home loan while you're still in Chapter 13 after 12 months of on-time payments and court approval. Otherwise, you will be looking at 2 years after discharge of on-time payments. Key factors number 1 and 2 are what can take the longest to recover from. With both, then you must show a history of on-time payments with no relapse. Key factor number 3, that's your credit score. Late payments, foreclosures, repossessions, collections, charge-offs, bankruptcies, high credit utilization are all negative contributors that lower scores. If you pay your debt obligations on time and show a history of not being late, then that in itself will increase your score. And by paying on time, then that will not trigger the other negative credit events. Here's another free tip. An easy way to help increase your score is to keep your credit utilization on revolving accounts to less than 30% of the credit limit. For example, if your credit limit is $1,000, then keep your balance to less than $300 on a monthly basis. It's even better to keep the balance to the 5 to 10% range to get a few more points in your credit score. Each person is unique in the credit profile they have built over the years. So it is best to have a lender, such as myself, review your credit with you. And a stronger credit profile does have the ability to overlook certain recent late payments. You can make the change. You can improve your credit profile. You can become a homeowner. Thanks for taking the time to watch the video. Be sure to subscribe and follow us to keep up to date on all of our home loan topics.